Good afternoon, everyone, and welcome to this important discussion on regulatory and investor engagement trends advancing sustainability in capital and economic activity. I'm Ronelle Govender, Global Sustainability Business Partner at Naspers Process, and I am delighted to be your moderator for the session. We are joined by distinguished panelists who will bring their unique perspectives across regulation, capital markets, and stewardship. So I would like to introduce you all to Lisa Johansson, Green Cape Finance Program Manager on my right, Koketso Borakale, Vice President of Sustainable Finance Investment Banking at ABSA, welcome, and Karishma Bulia, Senior Climate Risk Analyst at JustShare. Around the world, sustainability is no longer a nice to have. It's about how money flows, how markets innovate, and how businesses are starting to create long-term shared value. And in today's conversation, we are going to try and unpack these shifts. And what I would like to get out of it is, what does it mean to investors, regulators, and industry leaders? Lisa, I'm going to start off with you. How is Green Cape seeing regulatory shifts and policies translate into opportunities for green economic growth in South Africa?
Thanks so much, and thanks, you die-hard fans out there sitting in the crowd and whoever's online. Hi. Just a little bit about Green Cape. We're a non-profit. We are based in Cape Town. We do have a national footprint, and we really are looking at how do we drive investments and job creation into South Africa, utilizing the green economy as the mechanism? So really our North Star is investments and job creation. So utilizing that, one of the projects that we're working with, Christelle spoke about it a little bit earlier, is the South African Climate Finance Landscape. We've done, the first iteration was published in 2021. It was actually the South African Climate Finance Landscape 2020. We then did one in 2023, published in 2023, and those years that it covered was 2019, 2020, and 2021. And then we're right at the tail end of finishing or finalizing 2025's report, where we're looking at the years 2022 and 2023. And why that's relevant is because what we see when we go from a policy perspective and also regulatory perspective, perhaps a little bit controversial, or not controversial, but what we're seeing from the numbers that are coming out is that when some of those barriers and the regulatory barriers are actually relaxed, we see a flood of investments happening. And this is specifically around, what I'm thinking around is that it is with regards to the 1 megawatt and 100 megawatts policy reforms that happened back in 2021 and 2022. What it translated into is a huge flood of investment with regards to households and corporates going into obviously embedded generation, not just from a price security perspective, but a price and an energy security perspective, but also a price security perspective, I beg your pardon. And so the differential, and I can't actually give you the finalized numbers just yet, but we're actually seeing this massive increase of households and corporates really investing in that space in order to increase climate finance, specifically there. The other area that we really see this major shift, of course, is also with the financial closure of the bid round fives. So if we consider that the years that this was where we were actually monitoring, 2022, 2023, we're seeing those financial closures coming through. And I think just from a perspective of regulation and while you've got the one side where we bring in regulation, we bring in policy and certainty, those are things that give investors confidence. And we certainly are seeing that and bringing about that competitiveness and obviously leading to jobs. Those are looking backwards. What we're looking, just an example of looking forward, is the South African Renewable Energy Master Plan that's coming ahead of us. Green Cape looks at what are the opportunities in the economy with regards to investment going forward. When we look at renewable energy, we predict that there's as big a pipeline as 130 billion rands worth of solar being sitting at about 6 gigawatts and wind at about 3.5 gigawatts. And that South African Renewable Energy Master Plan potentially building out that value chain of renewable energy and green energy value chain, the manufacturing opportunity sitting at about 16 billion rand. So really, really nice where we do have these sort of mechanisms that we can play with, where we can then see that there's a real opportunity going forward, but also where we remove those barriers, such as the 1 megawatt, 100 megawatt, we actually see this complete flood of investment flows coming in. So much so that the increase was marked. It was absolutely marked. So yeah, I think that's, I'm going to pause there, but those are really some of the sort of examples where backwards looking, when we do shift these policies, where we shift these barriers, we can see that it opens up the floodgates, but also that when we do put in other policies, such as the South African Renewable Energy Master Plan, we're looking at ways that we can actually go forward and build in the manufacturing capacity in order for us to actually have further job creation and investments.
That's absolutely positive to hear. Koketso, how are evolving sustainability standards and regulations influencing the ability of African companies to access sustainable finance markets? And how can banks support clients in navigating these developments?
Thanks for that. Maybe let me also start with a brief introduction of, I hope everyone knows Absa Bank, but if you don't, Absa Bank is a Pan-African bank. We're headquartered in Johannesburg, but we service 12 African markets, including South Africa. And within Absa, I sit within the investment banking division in our corporate investment bank, and my team effectively is responsible for combining passion, impact, and finance or capital deployment. So we structure green, social, and sustainability-linked bonds and loans for our clients across the markets that I referenced on the continent. And yeah, ultimately ours is effectively capital deployment, effectively capital deployment towards sustainable and impactful projects and activities. So I guess against that backdrop, from a standards and regulations landscape perspective, I like to think about it in kind of three buckets. So there's the classification bucket. And again, I'm a banker and a chartered accountant, so I appreciate that there's probably sustainability reporting experts in the room. So pardon if I come with too banking of a perspective. But yeah, so I think about it simplistically within these three buckets. So your classification bucket, which is obviously, the, for example, the Green Finance Taxonomy or the ICMA and LMA principles. And this bucket of guidelines effectively serves to tell us what counts and what doesn't. So what do we get to actually call green or social? And in terms of what this means in the context of sustainable finance is that it really lends itself positively to ensuring that the integrity and the credibility of the products within the ambit or umbrella of sustainable finance is maintained, right? Investors, local and international, really want to ensure that there's almost like a standardization to the extent possible of, what is perceived to be green or social to avoid any concerns around greenwashing risk and the like. So that's kind of the first bucket, that classification piece. And then the second bucket is the disclosures bucket, right? So that would be like your S1s and S2s that has been spoken to quite extensively in previous panels. And, we see this as effectively, from a banking perspective at least, it's the IFRS of sustainability. So just like how we would obviously want to look to annual financial statements to determine, what kind of structures we can put together from a commercial standpoint. Increasingly, as there's a convergence towards adopting these standards, it's encouraging to know that there will be that level of standardization as it relates to sustainability and the related disclosures. And then the last bucket is really that law and policy. And Lisa kind of touched on the role that, this regulatory legal framework has really played in unlocking opportunities and kind of retrospectively looking. So I'll maybe touch on the, prospective and future looking regulations. So we think around Climate Change Act, Carbon Tax Act, and effectively, these regulations from a financing perspective are really starting to impact our clients' bottom line. And so when we think around the kinds of solutions that we can put together, we are very cognizant of ensuring that if we're solving or solutioning for a carbon intensive client, that structurally those products kind of satisfy, for instance, CBAM relevance as well in structuring. So that's kind of the thinking that we apply when we consider regulations and disclosures. But I will add that banks aren't auditors, so ours isn't to assess necessarily. Or assure rather that our clients' disclosures align with standard X, Y, and Z. Obviously, we pride ourselves in ensuring that the structures that we put together are highly credible and align with international best practice and market standards. But it's really more around how can we leverage our clients' ESG strategies and disclosures to really structure products that elevate that ESG narrative and are able to then be positioned and packaged and bought into by investors. So more than anything, it's about looking at what all of these little subsets rather of standards and regulations we can tap into in structuring those green, social, or sustainability linked instruments. And I think a good example, maybe just to tie it all together, is for instance, we arranged the sustainability linked bond that's currently listed on the JSE sustainability segment for SAPI. So that's the paper business, and effectively, again, in keeping with that idea of how can we extract metrics that are relevant, material, and robust for the business in putting together a market-validated instrument. The KPIs there had to do with GHG emissions reduction as well as sourcing certified timber. And it was the first sustainability-linked bond within the paper and pulp industry. So I think that's just a really good test case of how disclosures can actually support corporates in unlocking capital by bringing in sustainability coordinators like my team and myself in teasing out those really key metrics and relevant inputs.
Thank you. And flowing over to you, Karishma, nicely from that, is how effective are current disclosures and taxonomy frameworks in holding companies accountable to those sustainability claims mentioned?
So I think I should do the same and give everybody some context around where I am and where I come from. So Just Share is a corporate accountability and shareholder activist organization, and we're heavily focused on looking at how corporate South Africa is decarbonizing and reducing inequality. And when we look at the framework and policy landscape, what remains is that it is voluntary. Mm-hmm. It's voluntary and it's ambiguous in terms of what are the basic floors and ceilings around what disclosure is required. So from holding corporates accountable, it's not doing very much, but that's not to say it's not doing anything. So what we're seeing is that there's a bit of a disconnect between what you disclose and the impact that you're going to be having. So for the instance, if I take it to the banks, we see and we agree that a lot of good work is happening around sustainable finance and green bonds, but what we're not seeing is how that is going to translate into real world impact in terms of decarbonization in particular, as well as reductions in inequality. So we see a lot more disclosure in corporate reporting, but we're not seeing that translate into real world impact. And so what is a little bit worrying for us is that the policies and frameworks are really not set up in a way that is ensuring accountability and ensuring standardization. So we would like to see that corporates are doing things and disclosing a lot more consistently so we can actually compare things. Because at the moment, it's really, really difficult to compare something that is a quantitative metric. Like even if we're looking at your GHG inventories, for instance, looking at financed emissions, looking at scope 1 and 2 disclosures, it's not actually that easy to compare 3 companies and look at the same thing and say, this is apples and apples. And that's a quantitative metric that should be standard and easily comparable across the board. And when we get to things like sustainable and green finance, there's a whole lot of ambiguity around what constitutes sustainable finance, how it applies to different sectors, and differentiating what is sustainable and green finance from what is transition finance. And we're not seeing enough differentiation and clear differentiation around what constitutes one and what constitutes the other, and what's circumscribed and what's not. And to pick up on your point around renewable energy and financing, yes, it's great to see that we're moving to kind of really big investment, but we need to bear a couple of things in mind there. One, that it's moving from a very, very low base. So it's going to be great to see a lot of investment, but we still have lots of people sitting without energy. And the economics of that energy transformation is going to look very, very different from just corporate, like onboarding of renewable energy. And then when we look at it from a kind of broader macroeconomic perspective from South Africa, we have really, really fundamental structural problems in our grid and transmission. So we have a lot of money chasing renewable energy, but we have a backlog in terms of how that's going to be dispersed. So how is capital sitting, and is it being most effectively deployed for impact, is what I would say.
Thank you. Absolutely insightful. Koketso, I'm going to come back to you now. How are investor expectations reshaping sustainable finance products in South Africa and on the continent? And what does this mean for issuers looking to attract that capital?
Thanks for that. I mean, there's definitely expectations on both sides. I think investors have their own set of expectations, and so do issuers. And I'll maybe anchor this specifically around the sustainable bond market, just, given that we're at the JSE. But yeah, I think from an investor expectations perspective, the sustainable bond market has definitely evolved and matured since the first green bond back in 2017. And so this maturation of the market effectively has resulted in investors also becoming a lot more intentional, I believe, around the level of integrity that they expect from green or social instruments that they invest in. And what this means in practice is that there's heightened scrutiny around the KPIs, the metrics. I mean, from a practical perspective, when we take a client on roadshow and engage investors for a sustainable or green bond, the kinds of questions that we're getting now versus 3 years ago are a lot more robust. They really interrogate and go to the detail of, what is the transition plan here? Is the transition plan credible? And how does this correlate with the metrics, be it a sustainability-linked bond or, the use of proceeds that are earmarked for a green or social bond? So I think that's definitely been a shift in terms of expectations when it comes to where investors are looking to deploy their capital. And this is even more so if we're talking international investors. So that's the one point. I think on the issuer side, their set of expectations are more around, again, maybe speaking to the fact that the market is a little more mature now. So the expectation is, or the hope is that transaction costs would reduce. I think a key transaction cost, especially within the sustainable bond market space, would be the external verification requirement for one to be able to list a bond. And so, the hope from the issuer's perspective is that we'd start seeing more and more external verifiers come to the market, maybe have a little bit more competition, and so make it a little more cost efficient and cost effective to actually issue labeled bonds. I think that's the one thing. And then, I think this is the case for all issuers. Pricing, right? The main expectation is preferential pricing if we're ultimately going to come to market with a sustainably labeled instrument as opposed to a vanilla or conventional instrument. And I think lastly is also around liquidity and potential for even cross-listing. So again, expectations are around crowding in a more diverse investor base. So local investors, international investors, and even, potentially cross-listing on international exchanges like the Luxembourg Stock Exchange or the LSE. So those are the expectations that we're seeing. I think on both sides, a common one is definitely incentives as well. And that's something that within our South African sustainable bond market, I think we're missing. And from the investor side, we've seen in other jurisdictions, even on the continent, like the likes of Kenya and Botswana, that, there are some fiscal or institutional incentives in the form of tax exemptions on interest income in the hands of both non-resident and resident investors, so driving that market activity from the investor side. And then from the issuer side, as far out as, Singapore, Hong Kong, we're actually seeing government grants for, first-time issuers of these bonds to kind of cushion those transaction costs that I referenced before. So I think those are maybe like the core expectations on both sides and the common expectations for both. I think the biggest gap, though, is the driver of demand. And where we've seen demand really be driven quite extensively, at least relative to our local market, has been in the EU, where there's investor mandates for ESG-labeled assets and to invest in these asset classes. And so the absence of these kinds of mandates at an investor level, I think, is what we can attribute, that lull, if you will, in uptake of these instruments on our local market. So I think maybe, to consolidate that response, definitely investors are expecting heightened credibility and integrity in the structure of products that they're willing to invest in. Issuers are expecting pricing benefit that can only really be driven by demand, which by extension is driven by mandates. So unless and until all of these levers kind of come together and coalesce in one direction, we'll still kind of see a lag in uptake of these instruments within the market.
Lisa, in the previous panel, it was mentioned that climate and nature, different sides of the same coin. What trends are you observing in investor appetite for financing climate and nature-positive projects?
Perfect. I am a little bit more climate related, so I can speak comfortably to those. Nature is a difficult one. We've got sort of, from a high-level perspective, looking at the South African climate finance landscape, we're seeing this massive part going to mitigation. So it's actually sitting at about 84%, sitting in mitigation, with only 11% going into adaptation. So when we think about what is the appetite, I think we can all kind of agree there's something around money being like water, where it's easy and where there's less barriers, that's where it's going to flow. Where Keketso and the commercial banks, we're comfortable with renewable energy. We know what it's about. We're good with it now. And so we do have this sort of crowding in with regards to that. We definitely are seeing an appetite. And I think that there's definitely a willingness. I think that listed entities specifically, being here at the JSE, under a little bit more pressure to be showing that they are actually engaging and making these investments. I think that there will be some positive moves with regards to water, specifically around, it's a tricky one because adaptation is difficult, but now that we have the National Water Resource Infrastructure Agency taking much of the function that the the Trans-Caledon Tunnel Authority had, potentially getting its own balance sheet and being able to lend off that, I think that we are hopefully seeing a shift with regards to adaptation coming to the fore. I think that also with the massive pressure that's happening in Gauteng from an infrastructure perspective, in the rooms, we're seeing a lot of the conversations around that and what's going to transpire. Having lived in Cape Town, being there for the potential threat of day zero, that was also its own sort of little drama that happened there. But also what happened was also the level of investment that then transpired. And we actually saw that coming through in the climate finance landscape of the previous version, where there was a huge amount of investments into water because of the drought. When we have these shocks, we see that there is a response to it, and that investment shoots up. So while 22-23 unlikely to see, so this report that's coming out now, we're likely not to see a massive increase in water. I suspect that the report that when we do it in 2027, marking the years 24 and 25, we are going to see a spike, and that's specifically because of the water concerns here in Gauteng and the failing infrastructure. But we really are seeing an amount of investment appetite. The increase from the last report has gone up by 45%. And we're talking about billions of rands. So where the number prior was 130 billion rands, we are sort of looking at over 180 billion rands on an annual average for the 2 years that we looked at. Markedly also, I just want to sort of make mention that sometimes those, where opportunities arise is where policies have been put in, and here I'm going against what I said earlier, where we said like regulation makes it trickier and puts barriers in, but there isn't a place to find opportunities. So the Western Province has a organic ban to landfill. So it's 50% at this stage. It got put in 2022. By 2027, no organic waste can go to landfills. Cape Town and the Western Cape, we have very little airspace left. And so what's happening is we're seeing this real incredible opportunity to start finding alternative solutions to organic waste. And I don't know if, I'm sure a lot of you here have heard about, but black soldier flies. So suddenly we're seeing this huge market coming out of nowhere where it's a real opportunity to deal with organic waste that wasn't there prior. So some of the things that black soldier flies in their different stages, particularly let's talk about the larva stage where they've eaten the organic waste. They're now these little worms. You can either buy live worms. It's a replacement for chicken feed or fish meal. It's a wonderful addition or supplement to pet food. It's incredibly high in fat, incredibly high in protein. So an alternative protein solution that's available to us. Also the frass, so the waste that the black soldier flies provide, another alternative to fertilizer. It's incredibly high in nitrogen, in phosphorus. So there really are some clever nature-based solutions that are available to us while the black soldier fly is not... it's naturalized to South Africa. So it's not indigenous to South Africa, but it is naturalized. So it's not going to be able to take over and create a problem. So I'm going to pause there, but yeah, there is a huge appetite. I think that obviously there's a couple of areas where we're going to be seeing a little bit more of that, but yeah. Thanks, I'm going to pause there.
Karishma, we heard water flows like money. Are South African investors doing enough to use their stewardship to influence on climate, nature, and social justice issues?
So I feel like I'm making a very similar point, but I'm going to make it again because repetition is how we learn. I think we need to think about how we frame enough. I think like the South African investment community feels like they are doing a lot. They feel like it's tedious, they feel like it's onerous, they feel like it's complicated, and that kind of reporting fatigue that everybody who's ever had to do sustainability reporting will kind of look at you and say, I'm tired, is understandable, right? But at the same time, enough should be, are we really making a difference in building the kind of low carbon future we want to see? Mm-hmm. Are we building a future that actually enables nature, that actually enables people, and that actually enables inclusive development? And if we use that as the framing of enough, then the short answer is no, we're not. Because we still remain a carbon-intensive economy. We still see stewardship practices that are largely happening behind closed doors between companies and capital allocators with very little transparency. And we also see that the highest emitters in our country remain the highest emitters in our country and are failing to decarbonize and are failing to deliver on simple things like decarbonization. I say simple because the metrics are very clear. And then we feel them coming nowhere near around the more complex metrics around biodiversity and nature. So I think we need to kind of look at both of those things together. We do see pockets of excellence, but those remain pockets. We still are not seeing that fundamental structural shift in the South African economy, and that's where kind of stewardship needs to be focused. It needs to be looking at where are these big impacts and what do we need to do to really transition the South African economy and really transition South African companies, particularly our most carbon-intensive ones. So on that front, then South African investments need to be doing a lot more around holding companies accountable and being very, very clear around what you're holding companies accountable for and enforcing your accountability and being a lot more transparent about that.
Thank you. I'm going to go over last questions. And Koketso, in your opinion, what new finance instruments are starting to be prioritized to drive South Africa and Africa's just transition?
I think two come to mind very distinctly. Karishma did touch on the first one around transition and what transition finance even is, right? If that's widely understood. But I think in terms of the opportunity set from a financial solutions perspective, there's definitely a growing appreciation for the fact that decarbonization is not a point in time, right? It's something that has to happen, and it has to take the whole economy into the process. And sustainability exists on a spectrum. And I think what has currently been the case when we focus on purely green instruments has been the fact that effectively any participant within the economy that sits within this middle band is precluded from accessing that capital that would otherwise support their own business's transition. And particularly in the South African context, we understand how carbon intensive our economy is. We understand that a lot of the sectors that drive our economy are the likes of mining and steel and the likes, right? And obviously that our electricity is largely derived currently and from coal-based sources. And so with this growing appreciation, I think that's probably where we can start seeing a lot more interest and activity play out within the sustainable finance landscape. And much as there isn't a globally accepted or agreed upon definition for transition finance, but there is momentum, at least within the standard setting environment, in trying to get a little more clarity, standardization and understanding, common understanding of what we call transition. So, ICMA, the International Capital Markets Association, has put out guidelines that they're regularly updating as views around what constitutes transition evolves. On the loan side, the Loan Markets Association currently has an active global working group, technical working group, which we are represented on from a sustainable finance perspective as APSA. And through this working group, we are actively trying to incorporate African regional context and realities into the standard setting process to define what constitutes transition, so that the resultant standards that we are then required to comply with take our reality into consideration. So that's where the market is transitioning to, and the standards and regulations and guidelines are moving or converging towards and landing on a reasonably agreed upon definition for transition.
Thank you.
And then, sorry, just one last one. So I had two points. That was the transition point, and then it's carbon credits. I think, I don't know how well understood the concept of carbon credits is, but it's effectively the financial instrument that represents the equivalent of 1 ton of carbon dioxide or equivalent gases, either removed or avoided from entering the atmosphere. And in terms of financing for this type of instrument, or rather this asset class, it's largely been driven within the South African context by regulation. I mentioned the Carbon Tax Act before, and so we're seeing a bottom line effect hitting hard to abate sector corporates, and so carbon credits are increasingly being recognized as a mechanism to potentially support or manage their tax liabilities from that perspective. And so financing carbon credits backed projects, as well as trading resultant carbon credits on platforms is probably the next frontier as well within the sustainable finance universe and the solutions that are coming out of the financial service sector.
Thank you. I'm going to stop you there. Thank you. Lisa, in 90 seconds, which sectors or technologies show the greatest potential to scale sustainable investment and jobs in 2025 and beyond? And you can add your wish list in here, but in 90 seconds.
Okay, perfect. I think obviously the easy wins, I've got to go back to renewable energy just because the opportunity is so massive. As I mentioned, the number that we forecast up until 2030 is 130 billion rands worth of investments into both solar, wind, as well as battery storage. So the full sort of energy solution, obviously with the liberalization of the energy markets and through the we're obviously seeing wheeling as the real potential of growing that. Grid infrastructure, we know that it's difficult transmission. We know the challenges around there. So we do still see the potential though. And of course that Mpumalanga is still a growing area, and that's the easiest way to plug in is actually in Mpumalanga. A wish list, just because I've got a soft spot around it, is circular economy. Again, jumping back to renewable energy. What are we going to do with our solar panels, guys? What's going to happen there? I'm sure you've had a think about it. But of course the bid rounds that we've done back in sort of 2013, 2014, when we saw that all that activity happening, of course there being a long pause in between until 21, but some of those assets are actually coming up for the end of life. And so what is actually going to happen with those solar panels? So something that is floating around, we're seeing that eWaste Africa say, a company that we deal with on a regular, what is actually going to happen with regards to those solar panels, and what's the future there? So I'm going to pause there. I don't know if that was 90 seconds, but yeah, there.
Thank you. And Karishma, maybe you'll take us home. So, what is more needed to ensure that sustainability opportunities translate to real world impacts and not greenwashing?
I think to keep it short.
Yes, I know you're going to be passionate about this one.
I'm going to be so short about it, though.
Yeah.
I think what we need to start seeing is for companies and for capital allocators to start tracking impact and not just disclosure. So we need to look at where you're putting your money and the real world impact your money is having, and not just how many engagements you've had about a specific theme, but have you achieved actual impact on that theme. So if you've engaged with a high carbon emitter about decarbonizing, are you seeing that translating into real world decarbonization? Are you critical about their transition plans? Are their transition plans sufficiently circumscribed? Be clear, be direct, and monitor the impact.
Wonderful. So I think the message is clear, everyone. Regulation and investor engagements is not just about compliance, but it's reshaping how capital serves society. And I think the challenge we have here now today is how do we take all of these insights and input them into our businesses to make practical sense so that we ensure alignment between capital, purpose, and policy. I'd like to take questions, if there's any, for us.
Afternoon. Thank you very much for that informative session. Karishma, I just have a question for you. I recently read one of the research articles from Just Share that 5% of the top 40 companies have sustainability-related qualifications. And a trend that I've seen during my proxy voting journey is that this year more companies are tabling social and ethics committees. And I just wanted to ask you what you think an ideal social and ethics committee should look like, so that we can perhaps know how to strategize during engagements on the companies that we deal with. Thank you.
That's a very good question, and thank you for reading the briefing. I think what's important for us at Just Share is that diversity is about diversity in a diverse set of skills as well, right? So we want to see social and ethics committees that are not just composed of CAs and lawyers, and people with real, like, business world skills from a kind of commercial background. We want to start seeing more skills that, if you're going to be on a social and ethics committee, you understand what climate risk is, and you understand it beyond a very superficial level. So we acknowledge that a qualification, say, in environmental management sciences or something like that, is not necessarily a prerequisite. But we do want to see in the course of your career, if you're going to be acting on a corporate board, you have real-world experience with looking at what climate risk looks like. You have real-world experience with looking at what social impact and inequality risk looks like. So we want to start asking asset managers and kind of proxy voters to make sure that there's a diversity of skills, and skills are not kind of hyper-focused on what we're seeing them hyper-focused on right now, which is basically accounting, audit, and law is what we're seeing the skills compositions are of boards. We're not seeing a much more diverse set of skills, and to be able to respond to a diverse set of challenges, you need to have a diverse set of skills. And when we ask proxy voters to take that into account, we want to look at gender representation, we want to look at skills representation, and we want to look at broad basis of representation across both of those things, not just the one. And with social and ethics committees being up for nomination, it's the perfect time for using your stewardship much more impactfully, because you can start transforming those to be more impactful.
Another question?
Yes, hi, I'm Yvonne. So my question is just one. I mean, we all want to reach, net zero. What happens with companies that just could not be bothered and they don't report and they don't do anything at all? Are there any repercussions like a climate court and get blacklisted? Because I mean, it's not fair that other companies are doing their work and benefit, and they benefit out of the hard work of other organizations. What happens there? I think
Koketso or Lisa, would one of you like to take the question?
As to whether there's a climate court. I will say that I think what would probably really support a broader uptake or intentionality on the part of corporates to disclose and report, I think we are in an environment that is really driven by regulatory reform. And from an investment side, I think Lisa made examples of that earlier in terms of how the shift in regulation really unlocked a lot of opportunities. And similarly, I think from a compliance perspective, I think our economy is really more driven by the stick as opposed to the carrot in terms of alignment and quote unquote doing what's right. So I think once things like listing requirements and guidelines make it mandatory potentially for certain types of disclosures, or you see amendments in, say, the Companies Act in terms of what kinds of disclosures are required, incorporating S1 and S2 potentially. I think that's probably going to be a lever that can be used to really encourage, nudge or force, that kind of alignment that we all really want to see at the end of the day.
If I can just add, I mean, it's such a sidebar and it's not even an answer, so I'm afraid I don't actually have an answer for you on that one. But one thing that I just want to say is that at Green Cape, we really try and focus on what is commercially viable. Why I'm bringing that up is that we would like to say, well, we'll have a society that absolutely demands that we need to answer to our climate finance and climate requirements. Taking that out of context in a way is that there's got to be commerciality around a business solution that makes it, people want to engage with it prior to, so the idea of it being climate related, unfortunately that's not strong enough in this environment, and so there's no point in fighting that. The reality is that if it becomes a climate related solution that's commercially viable, that's when the magic happens and the economy sort of steps in. It's got nothing to do, sorry, this is just me thinking aloud, but it's got, I think you answered it pretty well. There's no climate court. We do have CBAM coming on, so the carbon border adjustment mechanism is going to come, and that will to a degree sort of deal with some of the hard to abate sector. But no courts just yet, I don't think.
And again, even the CBAM example, that's also an iteration of policy driving, desired outcomes and behaviors. So I think regulation and policy is a very significant driver to change.
I knew it. Go for it.
So from a stewardship and responsible investment perspective, companies that are not delivering on clear climate risk issues should be not classed as investable. I mean, that seems like a relatively simple answer to your question. But on the policy thing, we might not have a climate court, but we do have the Climate Change Act, and we do have the carbon tax, and we do have a lot of legislation that is kind of in process of being promulgated. However, the enforcement mechanisms are not strong enough. Carbon tax is not high enough. Measures for non-compliance are not high enough to ensure they're actually going to be resulting in behavior change. So when we talk about responsible investment and when we talk about corporate entities, we should be seeing corporate entities advocating for stronger policy, because stronger policy is going to hold everybody more accountable, right? Exactly. And if we have a carbon tax that's so low that it doesn't actually result in decarbonization, there's always this argument that, oh, well, carbon taxes do not work. But that's kind of a complete cart before the horse kind of argument. So we might not have a climate court, but we definitely should be looking at how we create a climate policy framework that ensures a lot more accountability. And now I'll stop.
Is there another question?
Yes, quick question from online from Deborah. So how is green investing SA being influenced by pullback on ESG in the US landscape?
Can you repeat the question? I didn't hear that.
Ladies,
I didn't quite catch that.
can you repeat the question for us, Tato?
So how is green investing in South Africa being influenced by all the pullback that's been going on in ESG from the United States, or in the United States, rather?
You want to take a bash?
From my perspective, what we're noticing is that obviously there's a far bigger influence from a Western Europe, UK perspective. It is nerve-wracking. It does exist. I think that it does have an impact. There is an impact. I don't know what that means in financial terms just yet, but we'll certainly be able to see sort of, I think in our next iteration of what happens in the 24-25 period, I've got a suspicion that we will actually see something to a degree. But at the same time, America is one of our trading entities. We do have the Europe, the EU, the UK. I think that it will somehow translate to something. I don't know if you've got an opinion.
I think from what we've seen, I mean, especially within the SA context, we are obviously very attuned to what's happening in the global north. But our context and our reality is very different. And so as a funder, for instance, we're still quite active in the renewable energy funding space because a priority for the regions that we operate in is energy security, and clean energy continues to be a form of ensuring energy security for our markets. So as much as I think a lot of our clients are aware of the sentiments coming from the USs of the world, we are an African bank that is solving for African problems with African-dominated clients. And so that's really been how we've navigated the geopolitical landscape as it relates to ESG. And I think I focused on renewable energy, but clean or green finance rather is very broad-based, right? You spoke to water. Sustainable water management is an element within the green finance landscape. In South Africa, in Tanzania, in Ghana, water is a challenge. So as much as there's a lot of noise around ESG and particularly around clean energy considerations for ESG, we take a very holistic approach to sustainability and categories that fall within the ambit of green, and we try to solve for very region relevant and region specific challenges from a funding perspective.
Karishma?
I'll be short, there's a lot to say, but I mean, picking up on your point, we have a completely different policy requirement. It's a fiduciary responsibility that South African investors take into account ESG. So our policy landscape is already framed in a completely different way. However, we are seeing, from a Just Share corporate accountability perspective, a lot more, I wouldn't go as far as calling it green hushing yet, but we're seeing a lot of tapering down around what was kind of being used as proactive marketing spin around being green and being sustainable. We're seeing kind of that toning down in corporate disclosures. We're hoping that's, well, in some way it's a little bit helpful because we're now looking at much more meaningful impact in what you're disclosing. It's not just PR spin. But we're definitely seeing a fact that that's tapering down. But what I would say is that as the JSE in particular and the policy landscape in particular of South Africa is quite enabling around the fact that we need to look at risk from an integrated perspective, and social risk and environmental risk are integrated into part of that. So we shouldn't be tempted to lean into the kind of green bashing anti-ESG wave that we're seeing, because I think it's going to be a short-run one.
I think you've nicely wrapped that. Are there any more questions online? None. So please join me in thanking our incredible panelists for all of their insights. Thank you, ladies.